Hello and welcome to Cafe Mutual YouTube channel. Friends, since tax season is near, many of you must have received queries on ELSS. However, there are a lot of schemes that qualifies under 80C, Section 80C of the Income Tax Act. In such a scenario, how can you persuade investors to invest in ELSS? To talk about this today, we have with us Rupesh Patel, Senior Fund Manager, Nippon India Mutual Fund. Rupesh has close to 2 decades of experience in equity research and fund management. So, without wasting time, let's welcome Rupesh. Good morning, Rupesh.
Thank you, Nishant, for having me on the show.
Okay. So, Rupesh, since equity markets largely remained flat last year with events of heightened volatility and all-time high numbers, in fact, most categories of equity funds have delivered not so good returns in the last year. So, in such a scenario, why should MFDs continue to recommend equity funds to their clients?
So, no doubt, I mean, if we look at markets last 1 year, it appears that market returns are not very great. But if you just step back and look at market returns from COVID lows, I think markets have given phenomenal returns. So forget COVID lows. I mean, even if you look at it from February 2020, that is just before this COVID related correction started, markets have given very, very good returns. But in recent few months, we have seen that, when the year had started, 2022 year had started, the narrative was all around, this low interest rates and high liquidity that will continue. And during the course of the year, we saw after the Ukraine-Russia war, the focus came on inflation. Interest rates were increased very sharply by central banks across the globe. And today we are at a point where there are clearly worries around global growth also slowing down on account of measures taken to cool down inflation. Now, in very near term, I think these are global uncertainties. These are very well discussed, and it is anybody's guess that in which direction things will go, whether interest rates or inflation will go up before they come down eventually. I think only time will tell. But when we look at India, I think there is a reason to remain constructive on India from medium to longer term perspective. And why I say so, I think we have to remember that there are two, three things which are more long term and structural in nature for India, and it will play out for many next years to come. So, what are these things? First of all, I think we have to keep in mind the demographic advantage, our own demographic profile. The very fact that India is a young country, we have such a large percentage of population which is young and joining workforce every year. Now, as these young people join workforce, they start earning, India's per capita income grows. We will see penetration levels for many consumer categories going up, newer categories getting created, and this will be a big driver for growth going ahead in multiple B2C categories going ahead. So the drivers around demographic advantage, they are in place, and the trends on demographics, they are not for few years. These are the trends which play out over decades. So in India's case, demographic advantage continues to remain favorable for many new next decades to come. So that's one thing which we have to keep in mind. Second important thing, what we need to remember is the reforms which have happened in last 6 7 years in the country. No doubt, reform process started long back, but in last 6 7 years, reforms like GST, reforms like RERA, reforms like insolvency and bankruptcy code, which to my mind is one of the biggest reform which has happened in the country, and many more smaller things wherein things like UPI, which have in a way transformed payment systems in the country. I think the clear benefit of all these reforms which have happened in recent times, they would be visible over a period of time. So we have to be cognizant of these reforms which have happened, and as I mean, we have maybe some of the benefits would have become visible by now, but because of COVID, some of these benefits got pushed out. But as we move ahead, I think the positive aspects of these reforms and many more reforms which are likely to happen should be more visible. And the third and the most important thing which has happened in recent times, which you need to keep in mind, is around the global developments after COVID, wherein China plus one today has become an acceptable strategy for global corporations. Companies, they want to diversify their supply chains away from China. And India is at a very attractive juncture in terms of capturing some of those opportunities. And government is also aware of these things. They are coming up with policies like production linked incentive. We saw corporate tax rates were brought down earlier, and many such supports schemes which are being put in place by government. I think taken together, these things have potential to create a boost for manufacturing in India, to create much more jobs in India. And I'm sure, I mean, as these three things play out, the argument for India's growth, it remains constructive, and eventually it has to reflect in companies' earnings and market returns.
But Rupesh, there are some concerns around valuation part. So how comfortable are you with the valuations currently?
So you are right. Actually, markets, if you look at the longer term history and study any market, it's not applicable only to India, but look at any market globally. Markets never trade at fair valuations for a long time. They are like a pendulum. So they move between extreme pessimism to extreme optimism. And it's not like that, okay, once you have moved in one direction, I mean, that's X point or a P of 20 is expensive, and that's where you have to necessarily sell, and it can't go up. Maybe it cannot go up from there, but it can remain there for a reasonably longer period of time. And there are a number of factors which drive that. So yes, I mean, if we look at last 1 year, one reason why India underperformed was that our valuations, they were higher as compared to other emerging markets. Our premium had gone up significantly. We have seen post this underperformance vis-a-vis some of emerging markets, this premium has come back to, I mean, I would not say it has come back to averages, but it has corrected from the highs which we had seen. So yeah, valuations are still, I would not say they are cheap. We are still maybe slightly above our longer term averages. But as growth picks up, I think valuation will not be much of a concern. And from here on, I think that most of the returns, considering the valuations where they would be more earnings growth driven rather than the re-rating led returns.
Rupesh, what's your outlook on equity markets, especially in 2023?
Yeah, so actually 1 year is a very short period of time in equity markets to really comment upon. My view is, as I said, that we have some of these factors which are structural in nature, which should continue to play out in India's favor. On top of that, there are some cyclical factors, like if you look at India's banking system, then the last NPA cycle has played out completely. Today banking system is not worried on NPAs. Almost all NPAs of previous cycle, they have been recognized and provided for. So they have the balance sheets to lend for next leg of for growth. Government is doing capex and focus more on infrastructure led capex. We are seeing meaningful investments going in roads, railways, and as I mentioned, China plus one. Even if some of these things come to India, it would be a very meaningful uptick for a country like India. So I think apart from structural factors, cyclically also we are very well aligned to do well. And going ahead, I believe that as these things come together, market returns should be healthier. But one thing which I would like to highlight and emphasize is that we have made, I mean, investors have made great returns from COVID lows. Last 2 3 years have been very great in terms of market returns. So please do not extrapolate those returns. Please moderate your return expectations in near term, but stay positive from medium to longer term. That would be my recommendation.
So, Rupesh, talking about ELSS, ELSS is by far one of the best tax saving options for investors. However, many Indians are yet to invest in ELSS. So, how can the industry make ELSS popular among people?
Yeah, that's a great question, and I have a little different take on that. I tell my investors and distributor friends that don't look at this ELSS only as a tax saving option. I mean, do not look at it as that this is an instrument where you can put 1,50,000 rupees, you can save taxes under Section 80C, and then that's the amount which you have to look at. It there is a lock in for 3 years, so after 3 years you take the money out and all. So I think that's not the right way to look at it. Maybe the right approach to look at this instrument is that It's a open ended. It's a flexi cap approach. It's a flexi cap approach. It's a diversified approach to construct the portfolio, because unlike some of the categories, there are no market cap related restrictions in terms of constructing the portfolio. It would be diversified across large caps, mid caps, small caps. And there is a 3 year lock in. So there is no restriction on you, that there is no condition on you that you have to take this money back or redeem this money back after 3 years. So look at it as a vehicle for accumulating equity assets. Look at it as a diversified fund which becomes open ended after 3 years. Because unlike other tax instruments where you have restriction on how much maximum you can invest, in this case you do not have any such restrictions. So
Mhm.
look at it as an instrument where you can invest as much as you want to. You can remain invested for as long as you want to. The longer it is, the better it is. And consider it as an investment option which becomes open ended after 3 years. So if you are a long term investor, if you are in any case investing with 5 to 10 years horizon, then this 3 year lock in will not really matter. And rather, I think psychologically it will help you avoid some of the big mistakes which one typically investors tend to make when markets correct. So I think that's the way one should look at ELSS funds, and do not restrict it as just an avenue to save taxes to the extent of 150,000 rupees.
So, Rupesh, value research data shows that while the Nippon India tax saver has not among the top performer in 3, 5, and 10 year, of late it has picked momentum in terms of performance, especially in the last 1 and 2 years. So, what are the three things that has been working well for this scheme?
I will say right allocation, right selection, and an effective risk management strategy. So
Mhm.
let me elaborate this a bit. Now, when I say right allocation, now if you look at construct of the portfolio, then you would see that even though my mandate allows me to have minimum 50% large cap, so according to my mandate, I have to have minimum 50% investments in large cap, and remaining 50% can be into large cap, mid cap, small cap. So last year, when there was a lot of euphoria around mid cap, small cap names, lot of euphoria around new IPOs which were coming, we actually decided to focus more on large caps where we saw significant opportunities.
Mhm.
And hence, today, if you look at our portfolio, almost 75-76% of our portfolio is allocated to large caps.
Mhm.
So this worked very well, because when this euphoria settled down, some of the mid cap, small cap, some of the celebrated IPOs which had come at very high valuations, they corrected meaningfully, and we could avoid all those large accidents in our portfolio. So that's how the allocation part worked for us. Selection, again, if you look at, I mean, one thing which I already talked about in terms of avoiding some of the expensive IPOs, or some of these new age tech companies which got listed, we avoided almost all of them. When there was so much euphoria around IT sector, we avoided almost all mid cap IT names, and we had gone significant underweight on IT. So that's something which really worked for us. We were overweight on banks. Within that, we were overweight on large banks. So that's something which again worked for the fund. So in terms of selection, if I have to sum it up in one line, maybe we avoided any big accidents in the portfolio, and we were right in terms of the stocks which we had picked for the portfolio. So that's the selection part. And third part, which I would like to highlight, is the risk management part. So we have put in place an elaborate risk management framework. According to that, it is capped in terms of how much minimum you have to have in large caps. This is to ensure that portfolio remains diversified across market capitalization. It remains liquid. How much deviation you can have from the away from the benchmark, how much active share you can have in your portfolio maximum. And in terms of the quality of portfolio, a certain quality of portfolio based on our internal risk rating has to be maintained at all times. So I think these are some of the pillars of our risk management framework. So combination of these three things, right allocation, right selection, and a prudent risk management framework, it really helped perform fund or deliver fund what it did in last 2 years.
Great. So one last question, Rupesh. How do
Yeah.
you position Nippon India Tax Saver Fund in the market as compared to other ELSs, and what gives it a competitive advantage?
Yeah, I think that's a tough one, but I'll not compare myself to other funds, what they are doing and all that. I think every fund manager has his own strategy, has his own approach to construct the portfolio and to approach the market. I have articulated my strategy, but I mean, if I have to give you some idea about my investment style philosophy, which would eventually reflect in the portfolio construction and the performance, then our approach is, I mean, we are not momentum investors. We are more like, get into good businesses, give them time to deliver, give them time to scale up. And once you get into such businesses, you should be willing to live through one or two bad quarters here or there. So this forms core of our portfolio. We look for businesses which have long runway for growth, where the growth can come on account of their linkages to the overall GDP growth, or it can be on account of market share shifting from unorganized sector to organized sector, or it can be because of trends of premiumization playing out, or it can be because of increasing penetration levels. So some of the financial services businesses will fall into that category. Some of the consumer discretionary businesses will fall into that category. So one part of portfolio gets allocated to such kind of businesses. At the same time, we are open to evaluating market opportunities on tactical basis. So at times, markets give you opportunities on account of, say, market specific developments, wherein some negative news comes and the entire market corrects. It can be industry specific developments, or it can be company specific developments, which leads to temporary dislocation in price value equation. And that's when you feel that the risk reward is very, very favorable. And even though these are businesses which you may not want to hold for a very long period of time, but considering the price point and the price value gap, there is an opportunity to make money. So we do allocate some proportion of portfolio to such tactical opportunities. And third, and the most important thing, we are mindful of valuations whilst buying these core portfolio, which is the growth stocks, and mindful of price value gap whilst looking at some of the beaten down names. So I think combination of these things have helped us deliver superior performance in recent times, and we believe that I mean, going ahead also we should be able to deliver reasonably consistent performance.
Great. So with that, we have come to an end to this interesting session. Thank you so much, Rupesh, for your valuable time and insights.
Thank you so much, Nishant, for having me on your show. Thanks.
Thanks. And finally, I thank each one of you for being such a wonderful audience. Have a great day, guys. Bye.